Bismillahirrahmanirrahim. Hi everyone. So today, inshallah, I will give some lecture on chapter 2, concept of derivative. Okay, so this is the uh, class for Fin645, which is an option under Malaysian derivative uh, topic. Okay, so the lecture outline for chapter 2, students should be able to know first definition of derivative. Okay, second, types of derivatives. Number 3, purpose of derivative market. Okay, especially focusing in Malaysia. Okay, number 4, major participant in derivative markets. Number 5, exchange traded versus over the counter. You will know about the description on both traded. Okay, and number 6, origin and growth of derivative trading. And last but not least, number 7, the structure and development of the derivative market in Malaysia. Okay, first, we go on the definition of derivative. Okay, part 1. Okay, the definition of derivative, as per stated under Security Commission 2002, derivative are the financial instrument whose value is derived from its underlying assets. Okay, what is underlying assets? Okay, underlying assets. Okay, what is the underlying assets? So underlying assets are the financial assets, okay, upon which derivative price is based. Okay, it gives the derivative their value. Okay, for our subject, which is an option. So the derivative that we will learn is a purchase and also option. Okay, underlying assets can be used to identify the item within the agreement that provides value to the contract. Okay, so we will learn more on the next topic. Okay, so derivative can be defined as a financial instrument whose value depends on the on or derived from values of other assets. Okay, what are the types of derivative? Okay, so they are the one that we will learn is forward futures and option. A contract or agreement to buy and sell asset at the future. Okay, so the price, the assets, and the delivery date must be agreed by today. Okay, types of derivative. First, forward. Forward is an agreement to buy and sell at a specified security at a specified price to be delivered at the maturity date in the future. Okay, so it is agreement. Both parties must agree, either the buyer or the seller, within at a specified date, specified price, and it must be delivered. Okay, at the maturity date in the future as stated in the agreement. The agreement is privately arranged to fulfill the needs of both contracting parties, a buyer and seller. If one party intends to close out the contract, it must be at the consent of the other party. Okay, so let's say the buyer want to terminate the contract, so it must get the consent from the seller. It is technically referred to as a privately negotiated agreement. Okay, the second one is futures. Okay, it is a legally binding agreement between two parties to buy or sell an assets at a certain time in the future for a certain price. So futures is more organized. Okay, legally binding agreement, which is it must have what we call the legally made from the authorized parties. A futures contract is an agreement between two parties to buy or sell the underlying instrument at a specific time in the future for a specific price determined today. Okay, as stated from our Bursa Malaysia 2009. Futures also developed as a result of insufficient trading requirement of forward transaction, okay, which is a private agreement. Okay. Under futures, a third party is required to act as a guarantor, okay, namely the clearing house. So the clearing house is they act as a third party or the middleman, okay, between the buyer and the seller. The clearing house serves as a buyer for every seller and vice versa. Okay, so this is the flow. Okay, the differences between forward contract and also futures contract. Under forward contract is more straightforward. Okay, from buyer to the seller, no third party or in other words, a clearing house in charge for that. Okay, but for futures contract, from the transaction from the buyer to seller, so it must be go through on the clearing house. Okay, either buy and sell. Okay, so this is two uh, differences, or not two differences. This is two derivative type of derivative, forward and futures. The flow of that particular types of derivative. Okay, so we'll see the difference here. Under futures, they have a clearing house, which is act as a third party uh, middleman. Okay, and the forward contract is more straightforward. Okay, so what are the differences between forward and futures? Okay, so with this is a features that you can see the differences between forward and futures. First is marketplace. For forward, they are not centralized. Okay, so for futures, they are more centralized, more organized. In under regulation features, forward is self-regulated. Okay, so if both party, the buyers and the seller agreed, so they can do the transaction. But the futures, it is commission regulated. Okay, under regulation, it is a commission regulated, which is they need to pay some commission to the clearing house, the middleman. Under trading, features for trading for forward is not, it is a negotiated contract. Negotiated contract between the buyer and the seller. And then under futures and option derivative, under trading, they are standardized contract. Okay, standardized contract, which is uh, satisfy or comply the requirement made by the buyer and also the seller. Okay, the features for transparency, under forward, they are not transparent. Okay, some parties must have their own agenda. Okay, either to gain a profit, or uh or they want to mitigate the any loss. Okay, so they have not some of the point or some of the requirement, so they have not transparent, did not declare. But for the futures and option, the they are more transparent. Okay, because of the clearinghouse intervention, so they have a more transparent, which is both parties, they need to comply all of the rules and regulation, okay, imposed, which is already agreed by both parties. And under margin payment, for forward, there are no legal requirement. Okay, no legal requirement, which is not compulsory. Okay, but for futures and option, there are legal requirement, so they need to comply. Okay, for features under credit and default risk, okay, for forward, it is more high risk. Okay, under futures, there are low risk. And guarantee of performance, forward, no guarantee of performance, and futures are guaranteed by the clearing house. The next types of derivative is options. So it is a contract which provide the holder or the buyer the right, but not the obligation, to purchase or sell a certain quantity of the underlying assets at an agreed price within a specific time period by paying a premium to issuer or the seller of the option contract. Okay, so this is stated by Bursa Malaysia 2009. Sorry. Option also provide a right to one party and an obligation to the other party. So after this, we will see what is the differences between purchase, forward, and also option. Okay, for in terms of buyer and seller perspective. Okay, so we look one by one. Okay, in the futures or forward uh, derivative. So for buyer of contract, it is an obligation. Obligation, so it's compulsory. Okay, responsible. They need to be responsible. Seller of the contract also is the obligation. But for option, for buyer of contract, it is a right. Okay, so dia ada hak lah untuk dia buat tu. The seller of contract, they have an obligation, okay, to fulfill, and they need to satisfy. Okay, for for call buyer of contract is to buy. Okay, call, buyer is to buy, seller is to sell. And for put, buyer is to sell and seller is to buy. Okay, contra with a call punya transaction lah. Okay, the next type of derivative is swap. A private agreement to swap or exchange a specific security or specified cash flow. The swap transaction generally arise due to the need of international businesses between two countries. By trading procedure, swap is very similar to forward as both markets are not regulated. Okay, but in this chapter or this subject, we are not emphasize on swap. Okay, so we only emphasize on futures, forward, and also option. Alright, so the next part is a purpose of derivative markets. So what are the purpose of derivative markets? So derivative market serves to provide two basic economic function. Okay, first is price discovery. Okay, uh, they want to set a price and also they want to disseminate the price for each of the particular underlying assets. And number two is hedging mechanism. Okay, hedging is some sort of like to gain a profit or to mitigate or to minimize a loss. Okay, hedging mechanism. Okay, price discovery. We go one by one. The ability of the derivative market to reveal information about future cash market prices. It is the revealing of information represents the consensus of participants today about the prices of a physical instrument in the future. Therefore, investor can easily discover the likely price in the future by referring to the derivative price today. Investor may have reference prices that could be used by them to enter or exit the market freely and easily. This price discovery will also enable investors to make better investment and consumption decisions about their exposure in the physical market. So who uh, prepare the price or who share the information of the derivative price? Of course lah, Bursa Derivative Malaysia. Okay, Bursa Malaysia lah, Bursa Malaysia. So you need to go to the website. You can see the price for each of the particular underlying assets. Okay, so price discovery, for example, Maybank declare profit first quarter. So futures market, uh, what you can do, okay, under future market, buy 1,000 share futures at price 10 ringgit, margin 1 ringgit. Okay, so pay 1,000, the account 1,000 shares futures was 10,000 ringgit. Okay, 1,000 times dengan 10 is equivalent to 10,000 ringgit. So demand increase, price future increase. Under spot markets, okay, buy 1,000 shares at price of 10 ringgit, pay 10,000 ringgit. So the account 100 shares was 10,000. Okay, so demand increase, price share increase. Okay, hedging mechanism. Participant in the purchase market use derivative contract as a substitute for the cash market transaction. Physical owners of a commodity use derivative instrument to manage their price risk systematically. Okay, so they will mitigate the risk. For example, if the underlying assets will incur a loss due to the drop of the price and so on, so they need to stop it. Okay, by doing the hedging mechanism. Price risk refer to the adverse price movement in the future that will affect their exposure in the cash market. The seller will sell futures today in anticipation of falling price, while a buyer will buy futures today in anticipation of rising price. Okay, so they expect, for example, you as a buyer, you expect that the price will be increased in the future. So you buy the underlying assets today because you expect the price will be increased in near future. Same goes to the seller. Seller, when they expect the price will fall in the future, so they will sell today. Okay, instead of they keep the underlying assets until in the futures date, then the price will be dropped. Okay, so they will making a loss. Okay, the next part is a major participant who participate in this transaction. Okay, participant of derivative market could be broadly categorized into hedgers and speculators. Okay, so we go one by one. First is the hedgers. Hedges are physical owners of the underlying commodity who will use derivative instrument to protect their risk exposure in the cash market. Okay, hedges are physical owners of the underlying commodity, the owner of the underlying commodity who will use derivative instrument to protect their risk exposure in the cash market. It's hedges. This is possible because of the economic function of a derivative market to provide a hedging mechanism for hedges. Hedges will use derivative market as a forum for managing unfavorable price movement. How about speculators? Okay, speculators on the other hand are traders who are attracted to the market in view of profiting from the volatility of prices. This is justifiable because they have to assume the price risk that hedges seek to avoid. They are exposed to high risk in view of their position as long-term traders who normally hold derivative contracts for more than 1 week. Their risk exposure, however, depends on their objective of holding, which is detailed in the next chapter, such as spreaders and arbitrage. So we'll learn on that spreaders and arbitrage in the next topic. Okay, so speculators is a traders who are attracted to the market in view of profiting from the volatility. Kalau hedgers tadi, they are the owner of the underlying assets. Okay, speculators, dia bukan pemilik of that underlying assets, but they want to take that opportunity to gain some profit. Okay, due to the volatility of the price, so they want to gain a profit from that movement of the price. Okay, exchange traded versus over the counter. Derivative instrument, like ordinary shares, always traded through an organized exchange. Okay, so first we will see the features for over-the-counter and exchange traded. Okay, first is the marketplace. Kalau over-the-counter is not centralized, okay, exchange traded is centralized. Regulation, over-the-counter is self-regulated. For exchange traded is commission regulated. Okay, so kalau commission regulated ni dia ada middleman, dia ada orang tengah yang kan menguruskan, okay, dia punya the trading ataupun transaction. Okay, under trading, for over the counter is negotiated contract as long as both party agree, so they can completely they can whatever transaction they want, so they can completely do, okay, the transaction. For exchange traded, standardized contract, so they need to comply whatever the contract stated. The transparency over the counter is not transparent, so maybe they have some hidden point that they did not disclose, okay, to the other party. And exchange traded is more transparent, okay, because they are organized by the authorized party. Margins payment over the counter, no legal requirement. For exchange traded, they are legal requirement, okay, they need to pay the margins payment. For credit or default risk, over the counter is very high. Exchange traded is very low in terms of credit risk. And then the guarantee of performance, over the counter is no guarantee of performance. In exchange traded, they have a guaranteed by the clearing house. Okay, origin and growth of derivative trading. So we will see the history of the derivative trading. Derivative trading originated formally from forward transaction. Okay, so they started in 12th century in Europe during the era of the Industrial Revolution. During this period, merchants forward their goods well before this could arrive at the designated ports. Mungkin jarak jauh kan, so dia dah buat penghantaran, okay, dia punya produk. Merchant forward their goods well before this could arrive at the designated port, okay, kepada certain punya ports lah, okay, pelabuhan. Since prices were settled at the time the agreement was reached, both buyers and sellers are protected against adverse price movement. Okay, so disebabkan jarak yang jauh untuk daripada satu tempat ke satu tempat yang lain, so mungkin ada perubahan harga. But the both buyers and sellers, dia telah dilindungi, okay, against the adverse price movement. Okay, so dia adalah starting of the derivative trading during 12th century. Okay, the first organized futures trading took place in Japan, okay, in the 18th century. 18 something lah kan. So which tickets were issued for entitlement of rice crops in the field. The trading was organized because merchants would buy this ticket based on their future needs of rice. Dia dah tahu dah dalam berapa bulan, berapa tahun, berapa banyak kilogram rice yang diperlukan. So daripada ticket tu is the agreement ataupun the agreed transaction, okay, for them in the future. The existence of the organized futures market were reinforced by the introduction of the date of delivery, grades and quantity of rice, and more importantly, the formation of the first clearing house to act as a guarantor by issuing the tickets. Okay, and then I think this is the last part, the structure and development of the derivative market in Malaysia. So the Malaysian derivatives regulatory structure, we have a Minister of Finance, the controller. Okay, so who are our Minister of Finance? Our PMX lah, kan? Datuk Seri Anwar Ibrahim. Nowadays, Security Commission, the regulator, okay, yang pembuat dasar and so on. Bursa Malaysia Derivative Berhad, the operator of the exchange. Kalau Bursa Malaysia Derivative Clearing is the clearing house. Okay, so Malaysia joined the derivative trading community. The launch of a crude palm oil trades future traded at KLCE, Kuala Lumpur Clearing Exchange, okay, October 1980. Thereafter, KLCE also trades the other national agro-based commodity, okay, for example, tin and also cocoa. For this reason, KLCE was named the first Southeast Asia multi-commodity futures trading in 1991. In December 1995, Malaysia became the first nation outside Japan to trade the local-based index with the trading of Kuala Lumpur Composite Index, futures at the Kuala Lumpur Options and Financial Futures Exchange, (KLOFI). In May 1996, Kuala Lumpur Interbank Offers Rates (PLIBOR) launched at Malaysia Monetary Exchange, and in December 1998, KLCE and MME merged to form the Commodities and Monetary Exchange (COMEX). In May 2001, KLOFI and COMEX merged to form a single derivative market known as Malaysian Derivative Exchange. Okay, Malaysian Derivative Exchange. So in March 2002, MDEX launched the first bond futures contract based in ringgit on the Malaysian Government Securities, MGS 2002. The Malaysian derivative market today have a single derivative exchange with a single clearinghouse and a sole regulator, which is SC lah, Security Commission, for all derivative traders. In 2005, MDEX is known as Bursa Malaysia Derivative Berhad, and MDCH also known as Bursa Malaysia Derivative Clearing Berhad, which is the clearing house lah. Alright, so we complete our chapter 2. So the next parts I will share the chapter 3 topic. Right? Okay, thank you.